This checklist is the operational summary of a lifetime of market lessons. To understand the full, epic story behind each step, the painful losses that created them and the epic victories they enabled, the essential pilot's logbook remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book. It is a deep psychological portrait of a master at work, a chronicle of the very experiences that forged this powerful framework. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below. The entire process begins not with a stock, not with a chart, but with a broad, sweeping assessment of the entire market. The first and most important step on the checklist is this. Step 1. Assess the general market trend. Before he ever considered buying or selling a single share of any company, Livermore had to have a clear, unwavering conviction about the direction of the primary market current. Was he in a great bull market or a great bear market? This was the foundational question upon which all subsequent decisions would rest. He knew, with the certainty of a man who had been bankrupted by ignoring this very rule, that the big money must necessarily be in the big swing. He was not interested in playing for small, nervous reactions against the primary trend. That was a game for suckers, a certain way to be ground down by commissions and whipsaws. His goal was to identify the great underlying tide, the line of least resistance, and to set his sails in perfect harmony with its powerful, irresistible flow. To fight this trend, he believed, was a form of insanity. He stated it as a simple, almost childishly obvious truth. The thing to do was to be bullish in a bull market and bearish in a bear market. Yet he saw traders violate this principle every single day. They would try to short stocks in a roaring bull market simply because the prices seemed too high. Or they would try to buy bargains in the midst of a collapsing bear market, hoping to catch the bottom. These were not acts of courage. They were acts of ego, of a man pitting his own small opinion against the market's gigantic, impersonal force. This first step required patience and study. It was not a guess, but a diagnosis based on a careful analysis of general conditions. He would study the money supply, the state of credit, and the health of the nation's key industries. He would observe the market's own behavior, its reaction to news, its ability to absorb selling, or its failure to sustain rallies. He would wait, sometimes for months, until the character of the market was unmistakably clear to him. Only then, with a firm conviction about the primary trend, would he proceed to the next step. With the great strategic direction established, the checklist moves to the next level of filtration. Step 2. Identify the leading industry group. Livermore knew that even in the strongest bull market, not all stocks advance equally. The great power of a primary trend is always concentrated in a few select industry groups. In his day, it was the railroads, then the steels, then the motors. These were the generals, the vanguard that led the entire market army. As they go, he said, so goes the whole market. His rule was to confine his studies and his capital to these prominent leading groups. To spread oneself thin across the entire list, to have an interest in a dozen different sectors, was to invite confusion and mediocrity. It is much easier to watch a few than many, he insisted. By focusing his analytical firepower on the handful of groups that were demonstrating the most profound strength, he dramatically increased his odds of success. He was not looking for a needle in a haystack. He was looking for the most powerful locomotive at the head of the fastest train. The leading group was not a matter of personal preference or fundamental analysis alone. It was a fact, proven by the action of the ticker tape. The leading group was the one that rallied first and strongest after a market correction. It was the one that made new highs with the greatest ease. It was the one that showed the most resilience to selling pressure. Its leadership was a visible, tangible thing to the trained observer. This second step, then, acts as a powerful filter, narrowing the speculator's focus from the entire market down to the single sector where the greatest opportunities reside. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Having identified the market's strongest battalion, the checklist demands an even greater level of specificity. Step 3. Select the leader within the group. This is the final and most critical act of selection. Even within the most powerful industry group, there will always be one or two undisputed champions, the stocks that are moving with the greatest force and conviction, while their peers follow in their wake. The amateur, in his quest for a bargain, will almost always be tempted to buy the laggard, the stock that has not yet moved, believing it is due to catch up. Livermore knew this to be a fatal and fundamental error. A laggard, he understood, is not a bargain. It is a weakling. Its failure to advance in concert with its stronger brethren is a profound sign of internal weakness. There is always a reason for this weakness, a reason that is often invisible to the public until it is too late. The professional does not buy weakness, hoping it will turn to strength. He buys proven, demonstrated strength, and he buys more of it as it becomes stronger. His rule was absolute. Concentrate your fire on the leader of the leaders. The leader is identified by its behavior on the tape. It is the stock that moves first. It is the one that makes the largest percentage gains on the highest volume. It is the one that acts right. It absorbs profit-taking with an ease that is almost contemptuous. It feels strong, vital, and alive. It is the stock that everyone is watching, the one that is making the headlines. To buy this stock, even at what seems like a high price, is not an act of chasing. It is an act of aligning oneself with the market's most powerful, concentrated force. His famous campaign in the steel stocks was a perfect illustration of this principle. He was bullish on the entire group, but he did not buy all the steel stocks equally. He began by testing both U.S. Steel and Utah Copper. From the very first day, U.S. Steel acted like a true leader, moving with power and purpose. Utah Copper, in contrast, was sluggish and unresponsive. Heeding the tape's clear verdict, he concentrated his full financial firepower on the proven leader, U.S. Steel, while leaving the laggard alone. This single, disciplined decision was the key to one of his most profitable campaigns. This third step completes the strategic selection process. The speculator has now moved from a broad assessment of the entire market down to a single high-probability candidate. He has identified the strongest stock in the strongest group in a market whose primary trend is aligned with his intended trade. The odds are now overwhelmingly in his favor. But the checklist is not yet complete. The final, tactical steps of timing, risk, and confirmation still lie ahead, the crucial bridge between a brilliant analysis and a profitable trade. Having completed the first 3 strategic steps of the checklist, the speculator has achieved what few amateurs ever do. He has identified the single most promising candidate for a major move in the entire market. He has filtered the universe of stocks down to the leading stock in the leading group, in a market whose primary trend is aligned with his intended trade. The great probabilities are now on his side, but a brilliant analysis is worthless if it is not matched by a flawless tactical execution. The final 4 steps of the checklist are designed to govern this critical phase, to bridge the vast and treacherous gap between a sound idea and a profitable trade. This brings us to the 4th and perhaps most difficult step of the entire process, a step that tests a man's discipline to its absolute limit. Step 4. Wait for the pivotal point. Jesse Livermore knew that the greatest and most costly mistake in speculation was not being wrong, but being wrong at the wrong time. To be correct in your analysis but premature in your action is to invite a slow and agonizing financial death. You are whipsawed by meaningless fluctuations, your capital is eroded, and your nerve is shattered long before the real profitable move ever begins. He learned this lesson not in theory, but in the brutal reality of his own account statement. He stated, with the pain of experience in his words, after forming a definite opinion with respect to a certain stock, do not be too anxious to get into it. Wait and watch the action of that stock. He knew that a stock, even one destined for a great advance, must first complete its period of quiet, unseen accumulation. To enter during this phase is to have your capital lie dormant and unproductive, or worse, to be shaken out by the deliberate engineered reactions designed to dislodge impatient holders. The professional speculator, therefore, must have the supreme patience to wait for the market's own signal that it is ready to move. This signal for Livermore was the decisive breach of a pivotal point. This was his psychological moment, the point in time and price where the long period of preparation was over and the public marking up phase was about to begin. It was only at this precise juncture, and not a moment sooner, that he would consider committing his capital. The wait might be days or it might be weeks, but the discipline to wait was non-negotiable. With the market finally arriving at the predetermined pivotal point, the checklist moves to the fifth and critically important step of self-preservation. Step 5. Define your risk. Before placing a single order, before a single dollar is put on the line, the professional speculator must answer the most important question of his business. How much am I willing to lose if my judgment is proven wrong? This is not a question to be answered in the heat of battle. It is a cold, calculated decision made in a moment of complete emotional detachment. Livermore treated his capital as a general treats his army's reserves, as a finite and precious resource to be guarded with the utmost seriousness. He wrote, "The speculator has to be his own insurance broker, and the only way he can continue in business is to guard his capital account." The answer to the question of risk, then, is a specific price point, a line in the sand. It is the stop loss, the predetermined point of surrender where the trade is proven to be a mistake and the position must be closed without question or hesitation. To enter a trade without this clearly defined exit point is to engage in a form of financial madness. It is to sail into a hurricane without a rudder, to enter a battle without a plan for retreat. The amateur thinks only of the potential profit. The professional thinks first of the potential loss. By defining his risk beforehand, the speculator transforms a reckless gamble into a calculated business venture. He has controlled the one variable in the entire speculative equation that is completely within his power to control, the size of his own loss. With the trend, the stock, the timing, and the risk all clearly defined, the checklist arrives at the moment of action. Step 6. Execute the initial probe. Even now, with every condition aligned in his favor, Livermore would not charge into the market with his full intended line. He was not a plunger in the reckless sense of the word. His first move was always a test, a small exploratory commitment. He would buy a fraction of his total intended position, perhaps 1/5 or 1/4. This was his final practical question to the market. He had done his analysis, he had waited for his signal, and now he was asking the tape, with his own money, "Am I right?" This method of starting small is a profound principle of risk management. It ensures that if, for some unforeseen reason, his judgment is immediately proven wrong, his loss is kept to an absolute minimum. It is a final cautious step into the water before committing to the full plunge. The amateur in his greed does the opposite. He enters his full position at once, maximizing his risk at the moment of maximum uncertainty. The professional, in his prudence, enters a small position, minimizing his risk until the market has given its final unambiguous confirmation. This brings us to the seventh and final step of the checklist, the market's own answer to the speculator's probe. Step 7. Demand immediate confirmation. This was, for Livermore, the ultimate and most powerful validation of his entire analytical process. A correctly timed trade, made in a true market leader at a genuine pivotal point, should not hesitate. It should, he insisted, show a profit almost immediately. This was not a desire for a quick scalping gain. It was a demand for irrefutable proof that he was in harmony with the market's immediate line of least resistance. He stated it as one of his most foundational beliefs. Experience has proved to me that the real money made in speculating has been in commitments in a stock or commodity showing a profit right from the start. An immediate profit was the sign that other buyers were present, that the upward force was real, and that the path was clear for a sustained advance. It was the market's own green light, the final signal that his campaign could proceed with confidence. If, however, the trade immediately showed a loss, it was a red light, an equally clear signal that his timing was flawed. The market was not ready. There was unseen resistance. To hold on to such a trade was to substitute hope for the clear, factual evidence of the tape. The checklist demanded one course of action: exit immediately. Honor the stop-loss defined in Step 5. Accept the small diagnostic loss and return to a position of cash, waiting for the next, more opportune moment. This 7-step checklist, then, is a complete, holistic system for professional speculation. It is a journey that begins with a broad, strategic assessment of the entire market and ends with a specific, tactical, and confirmed trade. It is a process that forces the speculator to move from opinion to analysis, from analysis to a plan, and from a plan to a disciplined, unemotional execution. It leaves nothing to chance, nothing to hope, and nothing to fear. It is a framework that transforms the market from a casino into a business. Each step is a logical and necessary prerequisite for the one that follows. To skip a step, to act out of sequence, is to break the chain of logic and to reintroduce the element of a gamble. By adhering to this checklist, a speculator ensures that he is always trading with the great probabilities on his side, that his timing is precise, that his risk is controlled, and that his judgment is confirmed by the only authority that matters: the market itself. This was the source of Livermore's power. It was his roadmap to fortune, a guide that is as true and as essential today as it ever was,